Well, we made it, folks. It's Friday, and you know what that means. It's code of professional conduct time. So I know we're going to go over the exam as well. I'll hand that out after we go through this stuff, but some important things that we need to talk about today. Before we start, just some reminders so that you make sure that you know what's coming up. I believe it's 2 weeks from today. Maybe I think it's exactly 2 weeks from today, but I could be wrong. We have the Excel assignment due. Excel assignment, not difficult, is time consuming. Please don't wait till the last minute to do it. I'll try to continue to give you reminders, but 2 weeks is a pretty good reminder, I think. So please make sure you do that. I think some people have already submitted those, and for those of you who have already completed it, thanks for being proactive. I never consider myself to be somebody who's proactive, but I really appreciate what people are. So the week after that is the why am I blanking on this? Professional interaction write-up. So we've had some professional interaction opportunities throughout the semester already. We've got them in 3 weeks. So you got to do a write-up on that. Hopefully you've already had your professional visit and you've developed your network out and you can write it up easily. If not, you might want to start looking very seriously at an opportunity for that, because if it comes up on the week of the 18th and you say, I have not had a chance for a professional interaction yet, Dr. Barnes, and I will say, have you been off campus all semester? So that's going to be my response. So please make sure that if you have not done it already, that you start looking for one now and start making sure that you have the opportunity for network development. We do have presentations coming up at the end of the semester, and one of the groups has already selected their presentation topic. So if you were hoping to do data analytics in the audit, no, unless you're the group that selected it, which unless you're the group that selected it, you're out of luck. So please reach out to your group members, start talking about project topics that you'd start like to work on. Those are listed in the syllabus. There's still plenty of good topics left, but they are first come, first serve. All right. So code of professional conduct. This is the AICPA code of professional conduct. And I want to read to you, I just did a Google search right before class because I wanted to come up with a really concise definition for how we actually approach this particular topic, because it's a little bit confusing the way that the material is put together. So this is from Google Gemini. The AICPA Code of Professional Conduct is a set of ethical and professional standards that outlines the responsibility of certified public accountants, emphasizing integrity, objectivity, due care, competence, and confidentiality. Now, you'll notice that definition, it doesn't specifically refer to auditing, though we are going to talk a lot about the nature of auditing requirements with respect to the Code of Professional Conduct. It is really, really critical that we understand the role that the auditor plays. And so we're framing this through the concept of auditing and assurance services, but it's important to note that the Code of Professional Conduct relates to any engagement that the CPA may take on. So please keep that in mind. Even though we're going to be talking about auditing specific concerns, this is a lot broader than just auditing. So as my disclaimer, talks about ethics related philosophy topics that you've heard many times before. Anybody taken a philosophy class here at Truman State? I will say, just guilty pleasure, I really enjoyed philosophy when I was in college. Yeah, I spent a lot of time thinking I wanted to become a philosopher. I guess technically I did become a philosopher because my title is now Doctor of Philosophy. But it's philosophy about accounting, which, what is that? Debits, maybe the debit should go on the left, or debits should go on the right. Who knows? Debits on the left, credits on the right, but the philosophy behind that still remains open. If you need a primer on ethics judgment, I recommend that you review the professional judgment framework we discussed on week 5. We already talked about that already. That was something we talked about on the exam. But if you are just concerned about some of the topics with respect to philosophy and ethics, maybe want to revisit that. Okay, so here's the deal. We're going to talk very quickly about rules of conduct, okay? And with one notable exception, which is going to be independence, which we're going to get into depth about, CPA exam doesn't focus heavily on the rules of conduct, all right? So these are things that are fairly intuitive and straightforward. I will ask you questions about them, but they're very easy questions to understand if you just have the basics down. I don't think it's useful to memorize the rules, but I think you should be able to understand and be able to define them. So here's what I'm going to do is I'm going to go very quickly through the rules. We're going to back up after I go through all the rules, and we're going to talk about a few exceptions to some of the rules and a few specific guidelines to the rules. And then we're going to talk about independence, because independence is something we've referred to a lot in this course. We need to actually define what it means in the context of an audit. All right, so first of all, first rule of conduct relates to integrity and objectivity. What does that mean? It means be honest and impartial in practice, okay? Which you may say that's really, really cheesy, Dr. Barnes. You just use synonyms for integrity and objectivity. You're absolutely right, I did, because I like to work smarter, not harder. All right. Independence, no material, direct or material indirect interest in the clients. So this can actually go a long ways. There's a lot of different things we can actually mean by independence. Independence is extremely important. I would say easily the most important rule of conduct that we're going to deal with, especially as it relates to auditing. We talk about general standards. General standards generally fall in one of four categories. Okay. Professional competence, due professional care, planning and supervision, and sufficient relevant data. Basically, what that means is if you conduct an engagement and do not have one of these factors present in the engagement, say, for example, you did not have a competent staff that performed the engagement, or there was not an adequate level of supervision over staff or senior and associate work, you are considered to be in violation of general standards. So generally speaking, this comes up a lot on that third one, planning and supervision. Oftentimes there's a lot of scrutiny as to whether or not there's sufficient planning and supervision over associate activities within an engagement. All right, compliance with standards, following generally accepted auditing standards. We haven't really gone into depth about what generally accepted auditing standards are, but these are mostly quality of assurance standards related to auditing as a whole. We've talked about professional standards. We've said the PCOB have their own set of standards. The ASB have a set of standards. General accepted auditing standards are kind of viewed to be kind of professional standards related to the practice of auditing as a whole, and to dictate the quality of the engagement performance that the auditors go under. So GAS is generally accepted auditing standards. Accounting principles in general, for the kind of guidelines we've talked about in this course, that's going to be follow GAAP. Want to make sure our clients are actually following the rules that are set forth in their business. It does not need to be GAAP. Keep in mind that we've already talked about special reporting criteria and or special reporting frameworks. If a client actually operates according to a different reporting framework, that is fine as long as they're not a publicly traded company. We can perform audits under different methods other than GAAP. But I will say that probably 99 times out of 100, if you go into become a career auditor, you'll be dealing with the clients who report under GAAP. It's very rare that you do not have that criteria as your basis. Action is creditable. Be good, okay? Don't do things that make people frown upon the profession. We've already had plenty of scrutiny over the accountants and doing bad things, so we want to make sure that you do the right thing. Contingent fees. Are contingent fees allowed? The answer is generally no, they're not. Okay, contingent fees. So what does contingent fees mean? It's like, all right, if you'll take me on as a client, I promise you that you'll get an unqualified opinion. And if you don't get an unqualified opinion, you don't have to pay me any money. Okay, we cannot do that as auditors. We cannot say conditional on performance. You can pay me. So contingent fees does not work. Commissions and referral fees, generally speaking, this is still going to be no, okay? We can't take commissions and referral fees for work in most scenarios. We're going to talk about some exceptions to that here in just a second. So advertising and solicitation, you've seen a theme here. You probably think I'm going to say no. Answer is no, that's fine. Advertising and solicitation is okay, as long as it's not misleading. So if KPMG wants to pay Phil Mickelson $7 million a year to wear that darn hat, they can go ahead and do it. By the way, I'm a little bit bitter about that because the whole thing with Phil Mickelson wearing the KPMG hat started in late 2008. Do you know what also started in late 2008? The global subprime financial crisis. Okay, so there was a lot less business for auditors to have. So a lot of my friends actually lost their jobs while Phil Mickelson was getting paid $7 million a year to wear a hat. Okay. I can't imagine the KPMG could have just said, you know what, we're not going to let you wear the hat. We'd rather not wear the hat. Why do you wear a hat anyway? Who does not know what account or what an audit firm is? If you know what KPMG is and know what their services are, you're probably already familiar with them. Wow, I'm really going on ranting and nobody is responding to this. Everyone's just like, Dr. Barnes is talking again. Okay, I'm sorry. So yeah, advertising solicitation. Yeah, it's absolutely fine. As long as it's not misleading. Confidential client information, it's confidential, obviously. So make sure that if it's confidential, that you do not disclose it. There are some situations where we can disclose it. We'll talk about those in just a second. Form of organization and name. You don't say aloud that you're allowed to perform CPA services that you're not. Generally speaking, when we talk about form of organization and name, that usually has to do with what is the structure of the organization. If you're a CPA firm, but not every single person in your firm is actually accredited as a CPA, you can't say my firm CPAs. So you'll notice that KPMG, EY, PwC, we call them CPA firms, but they don't have CPA after their name. It's because they have people in the firm who are not CPAs. So that's one of the things we have to keep in mind. If we're going to have CPA after the name, everybody has to be a CPA that works for that firm. What are some other, okay, that's it. That's all that we had to talk about. So let's talk about some notes on individual rules. Okay. So for contingent fees, these are generally not allowed. We can't take contingent fees. That's basically saying performance-based fees. However, there are a couple of situations that we can use them in scenarios. Okay. They can be used in the case of CPA representation in legal proceedings. So the CPA is required to make testimony in a particular scenario. Also, if we're performing compilations for third parties. So compilations for third parties means that we're actually preparing financial statements for a entity other than the one that is the subject of the compilation. So imagine that a bank comes to you and says, we'd like you to compile financial statements for a company that we're considering giving a bank loan to. That would be an example of a third-party compilation. We are allowed to give contingent fees in that scenario. Those are very, very unique scenarios that don't come up a lot, but it does happen. Commissions and referral fees. So one thing that's important to note is that as auditors, we are not allowed to perform advisory services or a lot of services that provide some sort of attest function. If we are auditors for a client, for the most part, we are just auditors. We can't perform other accounting services. So if they ask us, we'd like you to perform some tax services for us or for some non-attest service, we will generally say, no, we are not allowed to do that. However, we can, in that situation, refer them to another entity that could pay us a referral fee for that business. Again, very rare that it happens, but it can come up in some scenarios. Acts discreditable. This one's an interesting one. So acts discreditable, like I said, this is making sure that you follow the behavior guidelines of self and society, that you don't go around and saying, I'm a CPA, and then go get drunk and running around the naked on the campus of Truman State University. That's just a bad idea to do in general, by the way, okay? Don't do that in general. But yeah, you want to make sure you're following the protocols of your society and not misrepresenting the CPAs or the profession of CPAs. That being said, I have never seen a question about acts discreditable other than this one category, okay? So there are a lot of rules in this area, but failure to return client records following a client demand appears to be the big no-no. So if you're a CPA, you're working on a client, you've actually taken some records from them for part of your engagement, and they'd say, we'd like those records back. And you say, all right, I'll give them back, and then never do. That is a major violation of acts discreditable. And I will tell you right now, if I ask you a question about this particular topic, it will be on this particular issue right here, because this is the one that always comes up on the CPA exam. I don't know why. I don't know why there's not other rules about acts discreditable, but this one's always there. There's also a big list of professional threats and safeguards, part of the AICPA Conceptual Framework for Independence. They're relatively self-explanatory. So we're not going to go into a lot of depth on that. What we are going to do is we're going to talk about the I word, okay? The I word, which is big ol' independence, okay? So what is the definition of independence? Well, the independence rule is a member in public practice shall be independent in the performance of professional service, okay? Now, when we talk about independence, we talk about independence in the concept of being independent both in fact and appearance. Not just are we independent, but do we also appear to be independent to outside parties as well? So there's a lot of criteria here. They take independence very seriously, particularly as it relates to assurance, attestation, and auditing, okay? Independence is a big, big criteria. Now, we've talked about scenarios where independence is required, and we said independence is required here, it's not required here. But what does that mean? What does it mean to be independent? Well, first of all, it applies to all forms of attestation services, and anybody who is a covered member must be independent. Now, I know that everybody in this room is just asking, maybe you're afraid to ask. You're like, so you're thinking, I don't know what a covered member is, Dr. Barnes. Can you tell me what a covered member? Some of you are saying, no, don't ask the question because he's going to tell us. I got bad news for you. Even if you don't ask the question, I'm going to tell you, okay? So who are covered members? Big, long list of individuals, okay? So anybody who's on the attestation engagement team, okay? So if you're an auditor on an engagement team, you're there. Doesn't matter if you're a member of the firm or if you're just working for the firm part-time. An intern on the audit engagement would be considered to be a covered member, okay? So that's pretty basic. If you're on the attestation service engagement team, that includes auditing, because auditing is a form of attestation service. You are considered to be a covered member with respect to that engagement. So I'm doing an audit for Truman State University. That's not a good one. I'm doing an audit for Walmart. Okay, I'm doing the audit for Walmart. I cannot have any direct or materially indirect interest in Walmart whatsoever. That's not allowed. Okay. That could actually be something as simple as a mutual fund where Walmart's a part of. I may have to actually go through a new mutual fund that does not have Walmart as one of their index stocks. If I can, that's considered to be a material indirect interest. Okay. Individual in position to influence the attest engagement. So somebody who's in a supervisory role, maybe not working directly in the engagement, but has the ability to influence it. This is generally going to be partners in the firm. Okay. Also, a partner who provides more than 10 hours of non-attest services to the attest client within any fiscal year. So if we have another partner who does other work for the clients, they provide non-attest services, maybe they provide consulting services or legal services, they provide these non-attest services of more than 10 hours, they're also required to be independent of the client. Okay, is everybody thoroughly confused now? That's too bad because we're only halfway through the list, okay? All right, so the fourth one, a partner in the office in which the lead attest engagement partner primarily practices in connection to the attest engagement. Okay, so imagine that I am located in the Kansas City office. All partners are, I'm a partner in a firm. I'm located in the Kansas City office and I'm doing the engagement. What's a good Kansas City firm? Well, not an accounting firm, but that's a good one. We'll say I'm in the KPMG office, but what's a good company in Kansas City? What's that? MRG? Evergy. Okay. So, okay, KPMG, we'll say KPMG is auditing Evergy, okay? And I'm the lead engagement partner at KPMG, okay? Every single partner in the KPMG Kansas City office also has to be independent of Evergy, okay? They have to be independent because they are in that office. Now, the KPMG partners in St. Louis do not have to be independent unless they work directly on the client, okay? So location is an important criteria if you're a partner in the office. So if a partner in that office, if they're in the same office as me, the lead attest partner, then they have to be independent as well. Also, the firm has to be independent as well. So all the companies that KPMG audits, they cannot have material or immaterial direct interest. This is important to note because you've got these things called benefit plans, which are great. Is everybody familiar with the idea of benefit plans? By the way, if you go into work and you go into public practice, go into public accounting, take advantage of that. Invest as much as you can in that 401k. Invest as much as you possibly can because you're going to get matched, and it's really, really great, and you can make a lot of money really early on. It's good, but there are very, very specific rules you have to follow with investments when you're working in public accounting. Okay, and one of these is the public accounting firm can't have any interest, which really leads to some really, really weird investment portfolios because they can't be invested in some of these companies they audit. Any entity who's operating in financial accounting policies can be controlled by individuals and entities described above. Okay. All right. So yeah, anybody who's on this list and they've got control over an entity with financial account policies can be controlled by the entities. They have to be separate. Usually this is applicable to subsidiaries. If you've got an investment in a subsidiary or involvement in a subsidiary or control over a subsidiary, and that subsidiary is a client of yours, then that subsidiary is also considered to be an independent violation. All right, so has everybody got that completely down? Whole big list of covered members. Well, I've got bad news for you. I'm still not done, okay? I don't have more on the list, but I've still got more to talk about with respect to covered members. So prohibited financial interest, okay? Direct interest would be like stock ownership in a client. You cannot own stock ownership in a client that you're performing an attest engagement for or an audit for. So this includes partnerships and trusts. It is very, very specific. A direct interest is not allowed. What about material indirect? These are indirect relationships as long as it's a material amount, which is subjective, admittedly, but it's not a bright line criteria, but it is pretty, it is somewhat transparent. Stock ownership of a client subsidiary or mutual fund investments of a client, or even financial interest of close family members, which we're going to talk about close family members here in just a second. It's important to note there are some interests that can actually be preempted. All right, certain types of bank loans are okay, especially if you've got loans that are collateralized, or if you've got pre-existing grandfathered loans under the criteria that are set forth by the ACCT. In addition, if you've got credit cards in a financial client, say you're auditing a financial institution, if you've got credit cards, the threshold for that is generally $10,000. Okay. So if you've got a credit card and your credit card line is less than $10,000, you can go ahead and continue maintaining that credit card. If they say, we want to give you a credit line extension, you have to say, well, as long as it doesn't exceed $10,000, because otherwise I have to get rid of my credit card, which is not a situation I've ever had to run into, but just important to note, you have to be very, very careful of that. Okay. As far as business relationships go, Independence is imperative that the CPA performs managerial or other significant activities for an entity's organization during the time period covered by an attest engagement. So things to think about when we talk about business relationships. One of the big reasons we are not allowed to do certain types of services, whether those be attest services or non-attest services, or assurance services or non-assurance services, is whether or not we are actually auditing or performing attest functions over our own work. For example, let's say that I'm hired by a client to set up a new accounting information system in their organization. Later on, the client said, you did such a good job of that, we'd like you to perform the audit for the upcoming year. I would not be able to do that because if you think about it, if I set up the AIS system, the auditor later on is going to be testing the controls that are present in that system. I am effectively testing my own work. And how effective do you think I can be if I'm testing my own work? Let's just answer this question. How effective would most people be if they graded their own exams? I would be completely impartial, Dr. Barnes. I would give myself exactly the right grade. Okay. Yeah, sure you would. Okay. I know that would open a lot of ground. Says, oh, I know I circled B, but I meant to answer A. Yeah, that would exactly happen. Okay. So some lack of impartiality is going to be present there. So we cannot do that type of work where we're testing on work. Generally speaking, relationships and trade associations, so country clubs or honorary trustees of the client, which would be like an honorary trustee of a charity, are not considered pair independents. So they're very, very specific in making sure that there's no existing business relationships. But if you belong to the same country club, or if you're auditing a charity, but you're considered to be an honorary trustee, which basically means you have no financial say or no business say of the organization whatsoever, those are okay. Okay. So it's a little bit of challenge sometimes, but it's very, 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 it's very important to be able to make sure we can make that distinction. Now let's talk about something that is really, really dicey. All right. This is some area that I think is really important, but it's very, very confusing. And this has to do with family relationships. Okay. I'm going to tell you right now that all immediate family members or family members of a covered member are subject to the same independence requirements. I often ask questions on the exam where I say, which people are subject to covered member rules? Now, you notice the language on that is very specific. I did not say which people are covered members. I said which people are subject to covered member rules. So if you're a covered member, all immediate family members of yours are also considered to be covered members. They're covered by the same covered member rules. They have to have the same independent subscription. So who actually represents an immediate family member? That's going to be your spouse or your partner and any dependents that you have. So the dependents could include children who are still dependent on you. You could also say if you have family members who are dependent on you for support, those would also qualify as dependents. Kind of the same as tax treatment for dependents. All right. So those are immediate family members. In addition, independents may be impaired for covered members with close relatives who have material and financial interest in a client or a significant influence over the client. So what do we mean by close relatives? Well, we expand the family out a little bit. Those are going to be parents, siblings, or non-dependent children. Parents, siblings, non-dependent children. So if you have a father who's a CFO of an audit client, that would probably what you would consider be significant influence over that client. And you as the auditor have to say, I can't serve on this engagement. My father's the CFO. Or if we say my mother has a stock ownership that's significant in an audit client, you'd have to say, I cannot audit this client. My mother has a stock ownership that we've considered to be material or significant. Again, these are not covered members in name, these individuals on this list, but these are people who have to apply to the same rules that covered members do. So if I'm a covered member, for all intents and purposes, these people are as well. Okay. Last thing I want to talk about is I want to talk about some factors that can impair independence that are a little bit subtle. I think we may have talked about some of these already, but let's go ahead and get into it. Okay. So past due engagement fees, and these are engagement fees that are past 1 year due. So I'm an auditor. I have completed my audit. I issue the engagement fees and I'm trying to start the new engagement. But the first set of engagement fees that were due over a year ago, the client still has not paid. Can I continue to audit the client? And the answer is no. That's considered to be an independence violation. You might say, that's weird. Why is that an independence violation, Dr. Barnes? And the answer is, goes back to 303. What do we know about long-term payables? So if you have to change something from a short-term payable to a long-term payable, does it change the nature of that particular instrument? So remember when you talked about it in 303, you talked about the nature of long-term payables having something called imputed interest associated with them. So if you have imputed interest on it, even if there's no actual interest, you have to impute interest. Okay. If you're imputed interest, that becomes a note payable. So it becomes a form of long-term debt. Surprise, you're a creditor, which means you have an ownership interest in an organization. You can't be a creditor and still be independent. So that's why past due engagement fees over a year are considered to be violations of independence. Also, if there's actual or even threatened litigation. So if litigation is commenced or it's probable it will commence, the C against the client and CPA, independence is considered impaired. So you go in, you do your engagement, you finish, the client is really angry about something and they say, you know what, you guys did a terrible job. We are going to sue you for every dollar that you're worth. See you next week for the beginning of the new engagement. I think that's probably a point where I'd say, if you're going to sue me for every dollar I'm worth, I don't think I want to have a business relationship with you anymore. And that's what the AICPA says as well. It's like, if you're threatened or actual threatened litigation, you are no longer able to provide attest services in that particular scenario. And that is a summary of everything that we've talked about, everything we need to know. Again, really, really important. We're not going to spend a lot of time or depth on this, but I think it's something to make sure that everybody's familiar with. There we go.